Fiverr reported quarterly financial results on the morning of Wednesday, October 30th, that are sending the share prices up almost 20% as of this recording. Fiverr is a gig economy platform that brings together sellers of services and buyers of services together and takes fees for each transaction. That lucrative business model is one of the reasons why I've had Fiverr stock rated as one of my top stocks to buy here in 2024. So I'm happy to see the company's results being so positive. But is the stock still on my list of top stocks to buy after the surging stock price? I'm going to update that recommendation here in this video. I'm also going to review Fiverr's latest quarterly financial results and answer what is the big takeaways from the company's latest quarter. So there's a lot to cover. Let's get into it. I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. So Fiverr management team saying that their strategy to lean into value-added services to drive take rate expansion is working. And that's what I like to hear from management teams. We tried this strategy that we thought was going to be successful, and it turns out, yes, it is working. It is successful. The results are coming in better than we thought. I love to see this from management teams, and that's really the essence of a successful company, being able to develop and deliver new products, new services that adds to the company's existing products and services and keeps customers engaged with the platform. They also went on to say that they continue to grow wallet share among our customers, with the spend per buyer up 9% in the third quarter 2024 versus the same quarter last year. Fiverr has focused on higher quality buyers in recent quarters, and that's been a strategy that I've favored. You've heard me talk about this with several companies. Fiverr is one of them. PayPal has done a similar strategy. StoneCo, which is a financial services company in Latin America, had undergone a similar strategy. So I like these strategies when companies focus on profitable customers. You can't serve every customer profitably. You have to be able to target customers. And that's an essential business skill that many businesses fail to consider. So I like to see Fiverr thinking about this strategically and going after these higher profit customers, and it's paying off. The company's profits are increasing. They have strong cash flow from operations. The revenue growth might not be all that great, but that's what happens when you focus on more profitable customers. Your revenue growth slows down, but that revenue is higher quality revenue. It's not revenue from customers that are not going to come back. It's not revenue that you got just because you offered a promotion or incentive. It's organic revenue, and that's more attractive to me as an investor than revenue to customers that are not likely to come back. So because the results were so strong, the company is raising its full year guidance again. The strong performance in Q3 gives us confidence to raise our full year guidance for both revenue and profit. Third quarter revenue increased by 8%. The take rate expanded by 260 basis points to 33.9%. This is one of the reasons why I've liked Fiverr, because of the industry competitive pressures easing. When you have companies raising their fees, raising their take rates, and the other company is following, the other company in this category is Upwork, and they've been doing the similar thing, that increases profitability industry-wide. And so that's good news for investors. It's the opposite of what's happening in the electric vehicle industry, where everyone is lowering their prices, offering more incentives, doing more promotional activity, all of which is driving down profitability for the industry. This is the opposite, where these companies are raising fees, and then customers have to look around and say, well, we can't go somewhere else to avoid these fees because everyone is raising fees. So we just have to pay the higher fees. And that's what's been happening, and that's why the company is delivering these strong increases in profitability. And even though they had a decrease in buyers, right, 3.8 million, which is down 9% year over year, that's not great news here, but the buyers that remain are spending more, and it's offsetting the buyers that are leaving. And so the buyers that are leaving, you can see, have been very low spending buyers, because even if 9% of buyers left year over year, they still experienced 8% year over year growth in revenue. That demonstrates how the existing buyers on the platform are remaining the higher quality buyers. So they're not losing high value customers. They're losing these customers that maybe engage with the platform once every month or something like that and buy a small service or something like that. So even though you're seeing that decrease in active buyers, it's still an attractive strategy, and it could turn around where after those initial low value customers leave, the company could start generating growth again in active buyers. So another good thing about the revenue growth was that it accelerated from the previous quarter. 8% growth in the most recent quarter accelerated from 6% in the previous quarter. And they did see some trends stabilize, but overall small business sentiment continues to be challenging. Small businesses are not hiring as robustly as they were hiring in 2023. They're letting go of some employees. Job growth is not as strong as it was, especially in the tech sector. So it's understandable to see the company experiencing these headwinds from small businesses, but this is temporary. This is temporary. Small business sentiment being challenging, that's a temporary macroeconomic trend that fluctuates. It doesn't have anything to do with the company's structural long-term advantages. Again, they remind investors that they continue to generate strong cash flow and they execute disciplined capital allocation that allows them to pursue growth while delivering shareholder value. And thinking about the market longer term, the digital freelancing market in the United States alone is worth $300 billion annually. It's a huge market. It's a huge market that's growing. Hiring people on a contracting basis is a lot more attractive for businesses, and then for employees, for people working, for some it is more convenient. Some people like the flexibility of contracting work, and some people like the security of having a job. But not everyone wants to be tied to a job Monday through Friday. You have to go to work between a certain time and a certain time. You have close to zero flexibility with how you manage your life. Contracting offers you that flexibility. And so a lot more workers are now coming to contracting as a way to have better work-life balance. And I don't see those trends reversing. I only see those trends working in favor of contracting work and away from regular employment. Now, the big risk with Fiverr, and the reason why it had been trading so cheap. Remember, even before the company announced the earnings, I said that the stock is ridiculously cheap and undervalued, and I reiterated my buy recommendation. Usually before earnings, you'll hear me say that it's safer and better to wait until after earnings to buy a stock. Fiverr stock was one example where I said, no, you know what? It's so undervalued that you can buy it ahead of earnings too, because of how undervalued it is. There's more upside. And the reason why it was so undervalued is because so many investors are afraid of how artificial intelligence is going to impact Fiverr's business. But management keeps saying that AI is helping the business. It's not hurting the business. It might be losing some jobs on the platform, but there's new ones being created that are more than offsetting those that are being lost to AI. And the company says it again, in many ways, Gen AI technology has allowed us to deliver solutions in ways that were not possible before. So still, it's a net benefit for the company. And I don't see this as a net negative for the company longer term. I see it as, either flat or being positive for the company longer term, because so many new use cases will arise as a result of AI technology. All right, so is the stock still a buy? Well, now it's trading at a forward price to earnings of 11.6, and I still think that's ridiculously cheap for Fiverr stock. At a forward PE, it was closer to 8 before the earnings announcement, and now following the big jump, it's at 11.6. But I still think that it's cheap, and I still think that it offers investors a good value, a good risk versus return. So I've reiterated my buy recommendation here, stating that Fiverr is still one of my top 10 growth stocks and top 25 stocks to buy right now. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.